Good morning and welcome to Morning Markets here at True Potential. As we approach the end of the quarter, there remains much news flow for asset markets to adjust to and to price. And we'll begin with the US. Following the meeting of the Federal Reserve Committee last week, the first of the voting committee to speak publicly has confirmed that when interest rates rise to their peak early next year, they're likely to remain high and will not be cut even as inflation falls back towards target through next year. And this is the Federal Reserve indicating that it wants to really cool animal spirits in price-setting markets to ensure that there's no further burst of inflation through next year. The story in the UK is somewhat different and somewhat remarkable. We have seen the largest rise in gilt yields in 65 years. Following the commitments on the energy price cap freeze and the mini-budget, markets in the UK are struggling to price the true cost of the fiscal packages. And to give you some idea of how difficult it is to price, since the energy price cap freeze was announced at the start of the month, the cost of gas on the wholesale markets in the UK has fallen by almost 50%. So markets are adjusting aggressively, particularly the pound. Yesterday, the pound fell briefly to its lowest ever level against the US dollar before stabilising through the afternoon. Such has been the rise in gilt yields on government bonds and also in the fall in sterling that the Bank of England yesterday were forced to make an extraordinary statement to financial markets late in the afternoon. Now, the statement was somewhat unusual. It confirmed that the bank will not intervene in markets before their next scheduled meeting in November. But they did make it explicit that come that meeting, they will do what is necessary with interest rates to make sure inflation returns back towards target through the end of next year. What does that mean for markets? Well, markets now price that interest rates are likely to rise from 2.25% now to over 4% at that meeting. And indeed, going into next spring, interest rates in the UK may rise towards 6%. And this is an indication of markets really struggling to get their heads around the size of the fiscal packages from the government. And so they believe aggressive interest rate policy is going to be needed to ensure that inflation expectations and actual inflation remains under control. But things aren't just difficult in the UK right now. We've also just seen some political ramifications in Italy. Now, over the weekend, Italy had a general election where a coalition of right-wing parties won a majority, and so PM Meloni becomes the first female prime minister in Italian history, and she is seen as somewhat of a fiscal radical. And this has also seen yields on Italian government bonds rise aggressively. To compound matters, the president of the ECB, the European Central Bank, yesterday took the opportunity to confirm that interest rates are again likely to rise aggressively through the end of the year, even as expectations for growth slows across the Eurozone. So we're likely to see interest rates in the Eurozone that we haven't seen since before 2008, even as growth heads towards zero. And both the president and her chief economist, Philip Lane, took the opportunity yesterday to confirm that it's now down to governments to support growth as central banks, not just in the Eurozone, but the UK and the US, all are targeting bringing inflation back towards target very quickly. And this is what asset markets, not just bonds and currencies, but also equities, are struggling to price. An aggressive and unprecedented rise in interest rates, taking us back to levels that we haven't seen for over 15 years. So we do get some data this week, culminating with US inflation and updates at the end of this week on Friday. So please do join us tomorrow as we update you on events and markets. Thank you.
If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.